Ladies and gentlemen, welcome to BOQ's full year financial results for 2018. Before we begin, I'd like to acknowledge the traditional custodians of the land we meet upon today, the Gadigal people of the Eora Nation, and we pay respects to elders past, present and emerging. My name is Tani Mangos and I'm the Corporate Affairs and Public Affairs General Manager of BOQ. Thank you for joining us today in the room, on the phones and via the webcast. For today's presentation, Managing Director and CEO John Sutton will provide an overview of the results. Chief Financial Officer Matt Baxby will run through the numbers, and then John will return to discuss the trends impacting the sector, an overview of our strategic priorities and the outlook for the period ahead. This will be followed by the opportunity for analysts and investors to ask questions. I'll now hand over to John.
Well, thank you, Tani. Well, good morning, everyone. I'll start with the highlights of the results. The strategy we've been implementing in the past few years has transformed BOQ into a resilient, multi-channel business that is geographically diverse. It is therefore pleasing to report this evolution of BOQ has continued throughout this financial year. In FY18, we've delivered a good underlying result in what has been a significantly difficult operating environment. We've achieved consistent lending growth in our commercial niche segments. Asset quality across our loan portfolio has improved further and remains a key strength. Our strong capital position provides us with options to invest in the future and enhance shareholder returns for the long term. Looking at the key elements of the result, cash earnings after tax decreased 2% over the year to $372 million. Excluding the $16 million one-off profit on disposal of a vendor finance entity, which occurred in FY17, cash earnings increased 3%. While earnings per share decreased 3% on a headline basis, it did increase 1% on an adjusted basis. Return on equity decreased 50 basis points to 9.9%, or 10 basis points on an adjusted view. The ordinary dividend has been maintained at 38 cents per share, bringing the full year dividend to 76 cents per share. Turning to the drivers of the result, we've achieved lending growth of $1.5 billion. This was close to an $800 million more than in 2017. We also delivered a 5 basis point improvement in net interest margin to 1.98%. Our cost to income ratio was 47.5%, an increase of 20 basis points from the underlying level of 2017. Loan impairment expense reduced $7 million to $41 million, or just 9 basis points of total loans. There has been a significant shift in our business mix. Our strategy to diversify our channels has delivered material benefits. Noticeable improvements in the business mix, channel and geography positions BOQ to be more resilient over the longer term. Loans originated through Virgin Money Australia and BOQ Specialist now account for 20% of the loan portfolio. Since acquiring these businesses, both have delivered consistent organic growth, which we will expect to continue into the future. BOQ Business increased cash earnings by 10% this year, with revenue growth of 5%. It now contributes close to 60% of the group's cash earnings. Since FY14, it's delivered an uplift in lending balances of 6% per year. In addition, we've made good progress in digitising our back office as well as our systems and operations. This evolution is continuing, particularly in the technology space. While the business continues to grow, we've maintained a focus on delivering results. There is no doubt that 2018 has been a tough year for the banking sector. Public scrutiny and regulatory change, slowing credit growth and changing customer expectations have all had an impact. Despite this, we've delivered underlying revenue growth of 2%. This result was supported by a 5 basis point improvement in net interest margin. Lending growth was almost fully funded by customer deposits. There was also an improvement in the funding mix. expense growth was prudently managed at 3%, with core expense growth at just 1%. This was achieved while still investing in the business. The performance of our commercial niche business segments has been a standout again. We've achieved lending growth of $623 million across these segments, which include the health sector, retirement living, hospitality and agribusiness. In our housing loan portfolio, Virgin Money and BOQ Specialists continued to deliver strong levels of growth. These businesses contributed to $653 million of total housing loan growth. BOQ Finance had a particularly strong year with growth of $250 million. The prospects for this business remain strong. In the new financial year, we established a new partnership with Harley-Davidson to provide finance through their 46 Australian dealerships. This demonstrates our capability in delivering finance solutions to iconic global brands. The loan book in the branch network contracted. This is in line with the expansion of our channels and corresponds with a 27% reduction in branch numbers from FY14 to FY18. Despite this, we've seen an increase in deposit balances, with deposits per branch increasing 43% over that period. This shows the important role that our branches continue to play in our distribution footprint and their overall funding of the group. The improvement in asset quality metrics is very pleasing. Impaired assets and loan impairment expense both reduced 15% from FY17. Our bad debt expense was just 8 basis points of total loans in the second half. Arrears levels remain low and steady, comparing favourably with peers. These metrics are the direct result of a very deliberate approach we have taken to risk management. We have a clear risk appetite with responsible and robust lending practices. As I've said in the past, we have also benefited from validating 100% of our home loan applications. Our capital position remains strong, with Common Equity Tier 1 ratio of 9.31%. Customer expectations are rapidly changing when it comes to digital experience. We have therefore decided to take advantage of our strong position and invest for the future. We plan to increase capital expenditure in FY19 to focus on the business for future success. This will involve utilisation of 7 basis points of additional CET1 to enhance our digital banking platforms and improve customer experience. I'll talk more about this in the outlook, and for now I'll hand over to Matt to discuss the financials in more detail.
Thanks, John. I'll begin with the group profit and loss on slide 12. We've shown the headline numbers here as well as an adjusted view. And as John mentioned earlier, we had a $16 million profit on disposal of a vendor finance entity in FY17. The adjusted view excludes this due to its one-off nature. Our cash earnings after tax increased 3% on an adjusted basis to $372 million. Growth in lending assets and an improvement in margin helped drive net interest income growth of 4%. Expense growth was tightly contained at 3%, which meant underlying profit growth was 2% on an adjusted basis. Loan impairment expense reduced 15%. Turning to the half-on-half performance on slide 13, there was good momentum evident in the second half relative to the first, although this is primarily driven by a higher day count. Net interest income grew 3%, expense growth was kept to just 1%, and we saw a 14% improvement in loan impairment expense. All of this resulted in a 4% increase in second half earnings. In the first half, we began reporting on segment performance, which reflects the way we manage our business day to day. To recap, retail banking includes housing loans and deposits originated through the branch network, direct channels, Virgin Money Australia and our mortgage broker channel. For clarity, it excludes home loans originated by BOQ Specialists and also excludes SME loans originated through branches. These sit with BOQ Business, which also comprises our BOQ branded commercial loans, as well as BOQ Specialists and BOQ Finance. BOQ Business saw strong earnings growth of 10% on an adjusted basis, driven by above-system lending growth and loan impairment expense. In the retail bank, cash earnings were flat year on year, with margin improvement and good expense management offset by slightly higher impairments. Moving to the loan portfolio on slide 15, we delivered total loan growth of 3% for the year. This represented a year-on-year improvement of $797 million. This was made up of strong growth in commercial lending at 1.2 times system, driven by our niche segments. BOQ Finance also made a strong contribution with growth of $250 million. Housing loan growth of $653 million was driven by Virgin Money Australia and BOQ Specialist. This growth has been achieved while maintaining discipline around credit standards and further diversifying the portfolio by geography and line of business. Our Queensland exposure has reduced from 60% in 2012 to 44% in 2018, and our channels of origination have also diversified, with the broker channel delivering 30% of home loan settlements. Looking at growth by segment, on slide 16, you can see the breakdown by channel within each division. In the retail bank, Virgin Money had continued momentum with $932 million of housing loan growth in FY18 compared to $690 million in FY17. There was a $606 million improvement in BOQ housing loan performance, although the portfolio contracted as the impacts of lower branch numbers and more stringent credit practices relative to peers continued to be felt. In BOQ Business, there was solid above-system growth across all channels, demonstrating the value of our relationship-based service offering to business customers. BOQ Specialist's mortgage business saw continued strong growth, as did commercial lending to our niches of retirement living, hospitality and agribusiness. In total, these niches delivered $623 million of commercial lending growth during the year. BOQ Finance delivered continued year-on-year and half-on-half growth through structured programs in its target vendor and equipment finance customer segments. Moving to our funding mix on slide 17, there has been a 4% growth in customer deposits, with our deposit-to-loan ratio at 69%. This was driven primarily through our branch network, where our branches have become more focused on growing relationship-based at-call savings balances. This means we've been less reliant on term deposits. We also took opportunities to tap wholesale markets when pricing was tight earlier in the year, which set us up nicely for the second half. The improved funding mix helped to support our net interest margin in the second half, with an increase of 1 basis point to 1.98%. This represented a 5 basis point improvement in NIM year on year. We made a change to the weighted average life of our housing loans based on behaviour we've been observing in the portfolio over time. Due to the accounting treatment of deferred acquisition cost, this change increased net interest income and resulted in a 2 basis point NIM benefit in the half. This is evident through the third-party cost element in the chart. If this did not occur, our NIM would have contracted 1 basis point in the half. Stepping through the other moving parts here on slide 18, the second half has played out slightly better than we expected. The front to back book pricing dynamic is having an ongoing impact, with a drag of 5 basis points in the half. If anything, with the current pricing behaviour in the market, we are seeing the gap between the front and back book widen as the demand for new lending slows. We also benefited from some of the portfolio repricing activity during the half, which provided 2 basis points support for NIM. This helped to offset the impact resulting from the spike in bank bills relative to the cash rate. Elevated bills and hedging costs impacted our margin by 2 basis points in the half. On a positive note, and as I touched on in the previous slide, we took a number of steps to improve our funding mix, which benefited our NIM by 4 basis points in the half. This included reducing carded term deposit rates and utilising analytics and negotiated pricing to improve spreads in the TD book. We also saw good growth in savings accounts and took opportunities in the wholesale markets when they arose. The outlook for net interest margin is always difficult to forecast, but I'll take you through the moving parts as we see them. Absent a change in the market, the front to back book pricing dynamic is ongoing, and we would expect a headwind of around 5 basis points per half on this aspect. The last round of BOQ's mortgage repricing took effect in July, and we'd expect a benefit of around 3 basis points to flow through the first half of FY19. The cash to bill spread does appear to be structural, and if this is correct, it will remain a headwind in the period ahead. We've managed to hedge our exposure out to the new calendar year, but at elevated levels. Capital and low-cost deposits is expected to reduce NIM by around 1 basis points if current rates implied by the forward yield curve prevail. That leaves funding costs which can go either way depending on competition and market conditions. As always though, competitive dynamics and funding markets can influence these elements quite significantly in a short space of time. Moving to non-interest income on slide 19, and we've been saying for a number of periods that non-interest income is a very challenging line to maintain. This has been evident in the half with a $5 million reduction. Banking fees face ongoing pressure as customers gravitate towards low or no fee products. There have been limited opportunities to generate trading income, which has been reflected in other banks' results as well. Insurance income continues to trend lower. To address these headwinds, we've been investing in a digital financial markets platform, which is scheduled for launch in 2019. This will deliver a competitive offering for our business customers to transact in foreign currencies, as well as hedging their interest rate and currency risk. We've also seen year-on-year growth in Virgin Money Australia's white label product distribution business, particularly in the credit card portfolio. Turning to operating expenses on slide 20, and we've maintained a disciplined approach given the lower revenue growth environment. The increase of 3% was driven primarily by higher amortisation as we've continued investing in technology to support the business for the long term. We've increased annual capitalised investment spend from $29 million in FY13 to around $70 million in FY18. This is still only 6% of revenue, so not excessive by any means. Core expense growth was 1% year on year, which is a very strong result. We've benefited from initiatives such as increased digitisation and improved vendor management, which have helped to reduce costs. The rising cost of compliance, plus the investment required to support our faster growing businesses, means we continue to look for better ways to do things and make our processes more efficient. The software intangible balance reduced $26 million over the year. $16 million of this reduction was largely due to a more conservative assessment of the remaining useful lives of our intangible assets. Given the one-off nature of these software changes, the expense has been excluded from cash earnings, which is an $11 million after-tax impact. There were two other specific items that have been excluded from cash earnings this year due to their one-off nature. The legacy items category, totalling $5 million, is primarily related to the costs associated with the settlement of the Peterson class action, which was concluded in the second half. And the regulatory and compliance category, totalling $9 million, relates primarily to external legal costs associated with the Royal Commission and other regulatory events considered to be extraordinary in nature. We believe that given the one-off nature of these items, it is appropriate to exclude them from cash earnings. This should enable more effective comparison of BOQ's underlying performance across reporting periods. The asset quality trends you can see on slide 22 are all heading in the right direction. This is a direct result of the disciplined approach we've taken to managing within our clearly defined risk appetite. Impaired assets reduced 15%, while loan impairment expense was the equivalent of 9 basis points of gross loans over the year. After two unusually low halves, loan impairment expense for BOQ Finance returned closer to historic levels and more in line with what we regard as through-the-cycle loss experience. We've seen continuing strong arrears performance and have no concerns about the quality of this portfolio. The story is similar for arrears performance across our other portfolios, which have remained steady at low levels. Although some banks have reported an increase in housing arrears in recent periods, this has not been our experience. We credit this to our disciplined approach to lending standards and continued diversification of our lending portfolio. The slight increase in both 30 and 90-day commercial arrears is attributable to three facilities totalling $15 million that are expected to return to the performing category in the next half. If these facilities are excluded, arrears is in line with previous periods. Provisioning levels remain adequate across the portfolio. Total provisions decreased by $26 million during the year. The majority of this reduction was due to the specific provisioning balance, which declined in line with the reduction in the impaired asset balance. Our provisioning coverage is in line with our peers when looking at collective provisions and general reserve for credit losses relative to risk-weighted assets. The bank's new collective provisioning model has continued to be refined during the year and is reflective of the group's improved credit quality and model enhancements. As previously flagged, the new model has been designed in accordance with the requirements of AASB 9, which was formally implemented on 1 September 2018. As has been observed across the industry, the adoption of AASB 9 in the FY19 financial year has resulted in a one-time transitional adjustment. This has been recognised against BOQ's opening retained profits as at 1 September 2018. There will be a 3 basis point impact on capital arising from this, but no impact to the FY19 cash or statutory profit results. Finishing with capital on slide 25, our CET1 ratio remains strong at 9.31%. Underlying capital generation was 2 basis points. The impact from risk-weighted asset growth was higher than in the first half, partially due to a higher mix of commercial loan growth relative to housing loan growth. This is how our 2 halves tend to play out. The dividend impact was also slightly higher, as there was a lower level of DRP participation compared to prior periods. There are a number of one-off impacts to CET1. The regulatory and legacy costs we flagged resulted in a 6 basis point reduction in CET1, while the change in the weighted average life of housing loans consumed 2 basis points. The non-recurring adjustment to software assets taken in the half had a neutral impact on CET1. There was a positive impact of 6 basis points due to the capital-efficient securitisation transaction we completed in the half. There was a CET1 deduction of 8 basis points due to an increase in software spend as part of our BAU portfolio that occurred during FY18. This was more pronounced in the second half, but we expect this will continue in FY19. At this stage, we are planning to utilise the equivalent of 7 basis points of CET1 to support additional investment during the next 12 months in order to accelerate our digital transformation. I'll now hand back to John to provide some more colour on the outlook and how this will support the execution of our strategy.
Thanks, Matt. Looking at the broader picture, there are a number of long-term trends that are shaping the sector. These will create a host of challenges, but opportunities, especially for BOQ. The economic landscape is changing. Slower housing credit growth, lower house prices, and stagnant wage growth will have an impact on revenue across the industry. Customer digital needs remain a key focus, and we recognise increased investment is required. We remain in a highly competitive environment, and as a result, value change disruption continues at pace. In addition, banks face ongoing public scrutiny and the likelihood of further regulatory change. We believe BOQ is well positioned because of its simpler business model and risk-based approach. Our strategy to diversify lines of business is the right one. An example of this is the growth in Virgin Money Australia, BOQ Specialist, BOQ Finance, and our niche commercial segments. Progress has been made with improving our technology. We have successfully implemented a number of projects utilising our API gateways, allowing us to partner with third parties to deliver better solutions. For example, the new Virgin Money credit card app and digital financial markets platform, which is scheduled for launch early next calendar year. In 2019, work will continue on modernising our technology infrastructure, simplifying our core banking platform, and shifting towards a hybrid cloud environment. These initiatives will help us deliver improved digital banking platforms that meet the changing needs of our customers. Importantly, we know digitally active customers are more engaged, more profitable, and are increasing in numbers. We recognise that there is work to do so that we meet the needs and expectations of these customers. In 2019, we are accelerating a series of target investments to fast-track our digital strategy. This will include upgrading our digital banking and customer engagement platforms and modernising our call centre systems. These initiatives will be leveraged across all of our brands. The proven success of Virgin Money in Australia across multiple products gives us great confidence in this brand's future. Our aspiration remains for it to become a full-service digital bank. We are looking closely at new technologies which will significantly enhance the customer experience and develop the potential for this strong brand. In summary, the environment remains one of change, but we firmly believe that our strategy is the right one. What is particularly pleasing is the acceleration of growth we've seen across our niche business segments and Virgin Money Australia. We continue to deliver results while managing the business for the long term. Our asset quality metrics demonstrate our portfolio is resilient. We are taking advantage of our strong capital position to invest for the future. While the likelihood of further regulatory change is high, we remain committed to delivering positive customer outcomes. We'll also continue to advocate for competitive neutrality. Our future focus will be on enhancing the digital capability across the group. Finally, we are confident that BOQ has the key role to play in servicing the needs of retail and commercial SME customers now and in the future. I'll now hand over to Tani for Q&A.
Thank you. John will be taking questions from analysts and investors only. For those in the room, please wait for the microphone, state your name and the organisation you represent. Let's begin in the room. I've got a question here right in front of me. Thank you.
Thank you. Thank you, Victor German from Macquarie. Couple of questions, if I may. Matt, maybe one for you in terms of recognition of some of the expenses. I'm not going to sort of challenge you on recognition of software balances. You're an accountant and I'm not, so you know better than me. But certainly from a compliance-related expense, I mean, in the current environment, do you really think that it is one-off type expenses that shouldn't be included in cash earnings? Just your thinking on that. And if we do see higher compliance costs going forward, are you planning to exclude that from expenses going forward? And maybe second question for John. Obviously, lots of excitement on from Royal Commission recommendations. Be interested in your thoughts in terms of how you think it's going to play out for BOQ. Obviously, you haven't been as kind of negatively impacted by some of the comments from the Commissioner, but he did highlight one of the issues that BOQ actually may have with respect to remuneration and the structure of OMB. So I'm just interested in how you think that may play out for you.
I might take the first question, your second part of your question first, and then let Matt talk to the expenses. We run a very, very simple business model. We're servicing retail customers and we're servicing SME customers. Our owner managers have a huge connection within the bank and their communities, and they do a lot of great work in their communities. We've gone a long way to being Sedgwick compliant with our owner-manager branch network. We've introduced a balanced scorecard, and that balanced scorecard has key gateways relating to compliance, relating to responsible lending, and relating to deposit gathering and actually servicing our clients. We are comfortable that we will be able to meet the recommendations that may come out of the Royal Commission. I think that given the simplicity of our business model, stands us in good stead to actually continue to grow in the lines of businesses that we have, and we are fully supportive of our owner-manager model.
Yeah, Victor, I think in terms of compliance costs, I think your question had two parts to it. One was treatment of the one-off, and then outlook in terms of the second limb of that. So I'll pick those off each. In terms of treatment of the one-offs, we assess those case by case. Our objective is to enable comparability of reporting period on period. And in terms of the underlying nature of the specific costs that we've taken below the line there, in the regulatory and compliance bucket, it was about $9 million after tax. That was predominantly external legal costs relating to the the Royal Commission and some of the other regulatory aspects. So that was the predominant amount there. In terms of the outlook for higher compliance costs, what I would say is over the last few years, there's a number of costs that we absorbed in the business relating to compliance. John's called out that we've validated 100% of mortgages now for a number of years. They're costs within the cost base that we've absorbed. That's one example of many that we've taken into our operating costs and have managed to control them very tightly.
Okay, question here.
John Mott from UBS. Got just two questions on the NIM, if I could. The first one, 2 basis point benefit from the extension of behavioural weighted average life. And I think this is just reducing the deferred acquisition cost for the broker charges and must be owner-managed branches as well. Can you run through that? What have you actually changed? Are you now seeing less churn in the book because people can't refinance elsewhere, given everyone else is tightening underwriting conditions? There's a term mortgage prisoner, which is now being used for people who can't move out. What are we seeing there? And then secondly, on the NIM as well, comment around the deposit pricings being improving given sophistication in pricing of the TD book. It's another big word. So just wanted to get an idea on what those two drivers are. So the behavioural weighted average life and the TD book as well.
Well, I might just start at a high level and Anthony, I'm sorry, Matt, slip of the tongue there. Slip of the tongue. Sorry, Matt. Too many periods. And Matt can take you through the NIM walk. But in terms of the behavioural changes, we are seeing changes in loan behaviour, and people are not refinancing as quickly as what they've done in the past, and therefore also our runoff is less through the branches. I think there are a lot of moving parts in the market, and we're very firmly open for business. When we've assessed our loans, we've always done it on 100% validation, and even including for our interest only, we've actually done it on a P&I basis. So we're very comfortable with the behavioural aspects of what we're seeing on our loans, and what we did do was fairly conservative. In fact, it was a conservative setting that we took. And I think what you will see over the market as this plays out with the Royal Commission, as whether there are changes to credit underwriting standards at other banks, you'll probably see less velocity of repricing. But that's just an assumption that we have at the moment. Matt?
So, John, picking each of your questions off, one on weighted average life and the other on deposit pricing. The first around the weighted average life change, that is something in our portfolio we've been observing over time. So less churn, customers are staying with us for longer. As a result of shifting that from sort of 5.5 years out towards 6, with quite a big buffer actually in terms of that underlying behaviour, that resulted in deferred acquisition costs being spread over a longer period, and that shows up in the third-party cost line of the NIM walk. The second part about deposit pricing, I think there were two things at play. One, and again, this is something we've been talking about over the last couple of halves, is a concerted push towards what we call relationship-based deposits. So, we've seen 7 to 8% growth in low-cost transaction account balances. That I think reflects our service offering of staying closer to our customers. In terms of the way the TD book has played out, part of it has been less reliant on TDs as a result of the growth in at-call savings, and the other is a project I think John kicked off a number of years ago around using analytics to really understand the elasticity of our term deposit book. And I think, as many of you will have known, BOQ historically has played above others in terms of carded rates on TDs. That hasn't been the case over the last 12 months or so. So it's really tightening of the TD spreads.
So how much have you pulled TD prices down?
It depends on the different buckets that we use, and I think I've said this in the past briefings. It's fighting for every basis points and looking at each side of the balance sheet, and it's actually taking those opportunities when they arise. And even in the wholesale funding markets, at the beginning of this year, we could see a really strong opportunity to be able to lock in some wholesale funding at very, very attractive rates, which we chose to do. And also on the cash to bill spread, we've taken those opportunities when they arise to actually hedge as well. And the TD pricing is dynamic. I think that the days of BOQ having these massive maturity towers of TDs rolling off and then having to bid them up is over. We're carefully managing both the deposit side and the lending side of the margin.
Okay, I think we've got a question here in front.
Thank you. It's Anthony Hu at Deutsche Bank. Just can I ask you about your mortgage book in your proprietary network? It looks like the runoff deteriorated in the second half versus the first half. Can I just ask about how do you improve that, and is that particularly disappointing in light of the fact that the branch rationalisation process it has been a few periods since that was supposed to have settled down, and also given the fact that as peers have tightened the lending standards and have reverted towards where you have been, that should have given you a better competitive position this period?
There's a few parts to that question. Actual runoff in the branches, a percentage of runoff has actually moderated, and what we do need to do is to put more on the top of the funnel with our corporate branches and our owner-manager network. So it's not so much the runoff, it's about filling the pipe. And we're currently in our spring campaign, and the results early on are good. Would not expect to see us or that branch, the branch network, return to positive growth this year. We'll certainly look to moderate that flow. Your question about peers catching up to underwriting standards, I think that's very much an open question. I still see through different intelligence sources that other banks still have a long, long way to go. People are certainly validating income, but there are other competitors that have a long way to go towards validating expenses. And if there's one comment that I would make is I think that the industry would benefit greatly if there was greater clarity around the validation of expenses and the playing field was materially evened up in that regard, because I still think and still see that there is a long way to go with certain other players within the market.
Question over here.
Thank you. It's Andrew Triggs from JP Morgan. Just a couple of questions, please. Firstly, on the NIM, some good commentary as always on the outlook, but just perhaps a sense of where the exit margin sits versus the average of the half. That'd be my first question. And second question, John, you mentioned that you look compliant, that you believe you're compliant with the Cedric recommendations.
I said we're moving towards it.
Yep. Just in terms of both the Fit for Biz reward program and the balanced scorecard, I mean, ultimately they all sort of rely on value-based commissions. Just your thoughts on can you rejig that structure to make it fully compliant with
I think
where the industry appears to be moving?
I think there's a number of dimensions to look through this. So obviously we continue to have our Fit for Biz program, and our Fit for Biz program does reward our owner managers for their compliance, for their work in their community and what they do. We do have commission-based sales within the owner managers, but it is like what it's like what happens in the broker network. We do have gateways. We do have rigorous compliance and rigorous auditing of our branches, and it's difficult to hypothesise where the recommendations will fall out of the Royal Commission, but we have done a lot of work internally on what models may or may not look like. And I think that when you think about this, you need to think about it in terms of the broking industry as well, and what changes may or may not come out of that. We've engaged with our owner managers. We're working with our owner managers. And I think the most pleasing aspect for us is that they have embraced this. 80% of the owner managers are now on the new balanced scorecard, and we did moderate that balanced scorecard earlier this year. We've just come off conference, and they see this as a great opportunity to actually be out in their communities and offering the services that consumers want.
In In terms of the first part of your question around spot NIM, we think that's probably less meaningful, and it's part of the reason we do talk about the moving parts. And in terms of the experience that we have today, they're largely in line, as I've talked about. Ongoing competition on front book, particularly for owner occupied, as the market begins to slow. Quite aggressive TD rates out in the market still, and then the final part is really basis. We've seen that moderate slightly, but still remains at elevated levels, certainly relative to what we saw at the front end of FY18.
Just to top that off too, Richard, is I think that when you look at the bank, you need to think of the bank just not through the prism of the owner-manager network. These results have shown tremendous growth in Virgin Money. We've got a $1.6 billion loan portfolio in a fairly short period of time. Attracts a materially different customer base to what we traditionally have. It's allowing us to diversify away from Queensland. If you look at BOQ's housing growth, 644 million. 2014 we acquired that business. That's now $4.3 billion in mortgages. And that is flowing through into the improved arrears given that particular clientele that's in that business. BOQF lending, 250 million. For many years it's been the unsung hero of the bank, but we're now partnering, and we've been doing it for quite a few years, with global iconic brands, and we continue to see further growth in the BOQ finance business, and it's an important product and tool for small businesses. And this year in our niche commercial lending, we've done really well. So think about the bank it's not just in a component part of owner managers, but the whole.
I'll take another couple from the room. Just here, thank you.
David Ellis from Morningstar. I've got two questions. The first one's about the St Andrews Group sale, the announced sale to Freedom Insurance Group. Considering the challenges that Freedom are currently experiencing, do you expect this sale to complete as planned?
Probably the most practiced question I've had. So we have an agreement in place, and it is subject to regulator approval, and I really can't speak any further than that on that matter.
Okay, my second question is to do with the margins and the increase we've seen over the last 9 months or so in short-term wholesale funding costs, and you reference the spread between the cash rate and bills, and I think you mentioned, Matt, that you consider that structurally high rather than, and you didn't say cyclically high, but what are the reasons do you think that it's structural rather than cyclical?
I think there's probably a few parts. One is, as we've seen a similar dynamic in the US unwind, that hasn't followed in Australia in the way that we would have expected as one point. And then I think other elements to it have been the dynamic around who's on the other side of some of the trades. Early on, we saw repatriation of tax proceeds in the US as one of the drivers. That seems to have largely played out. Yet basis remains structurally high. So I think there's and we've heard most of them, a variety of views across the market in terms of the real drivers of it. Based on everything we've seen, it looks like it's more likely to be sustained.
Okay, just over here, please.
It's James Ellis from Bank of America Merrill Lynch. Assuming that St Andrews does go ahead, can you just confirm that it's 20 basis points of capital that you would still expect to be released? And
about 17, I think, James. Is that right?
17.
Yep.
And 6 months ago, when you announced that, there was a slide which sort of gave an array of sort of choices for the capital, including capital management. What would assuming the transaction goes ahead, what would be your thoughts around deployment of the capital?
I think what we've shown today in the results that we do have a high degree of optionality for capital, and I'm not going to make any comment about what we would do around capital initiatives. But what I will say is that we fundamentally believe in the strength of Virgin, and that is an iconic global brand, and we've already demonstrated through Virgin over the last few years what it can do, and we have under active consideration some investment which would be in the existing capital envelope that we may undertake to accelerate Virgin further on its journey to become a full digital bank, and that may be around deposits or other types of products and services.
Okay, we may take some calls from the phones.
First question comes from David Spotwood from Airlie Funds Management.
Yeah, thanks. Can you provide some comments on the cost outlook? There's a lot of comments in here about the digitalisation and investment in IT, and not a lot on the sort of the outlook for the cost line. So thanks.
Yeah, David. I guess as we've laid out, there's been a real disciplined approach to managing costs. I think in a lower revenue growth environment, that's absolutely the right thing to do, and a focus that we're going to maintain. In terms of the outlook, what we have called out is certainly this year and then moving forward, we're running slightly higher technology investment. We think that's the right thing to do to position the business for the long term. So we will see some of the drag of that amortisation flow through over the next few periods. But yeah, I guess what's incumbent on us is continuing to look for opportunities to structurally shift the cost base, and that's where things like digitisation, rolling out tighter vendor management, looking at ways of serving our customers in a way that improves the processes is where all the focus is.
Our next question from the lines.
Next question comes from Azib Khan from Morgans Financial.
Thanks very much. Look, three questions for me. Firstly, so on the 7 bips that you'll use to accelerate investment spend, can you provide a rough breakup of what you anticipate in terms of OPEX and CAPEX? Also on that, are you hoping for any productivity savings or headcount reduction to stem from the acceleration? Second question is, so historically BOQ's mortgage fulfilment times have been inferior, particularly relative to the major banks. One of the reasons you have cited for that in the past is that you do 100% validation. Given that many of your peers are now doing more and more validation, is that gap between fulfilment times now closing? And is that starting to provide a positive delta to your position in the broker channel? And when can we expect BOQ to actually match the majors on fulfilment times? And the third question is, apologies if I've missed this in your disclosure, but are you still sticking with an interim CET1 target of 9.25%?
I'll have a go at answering most of those questions. So for us, around the 7 basis points investment spend, it's across 3 key areas. And the first one is the Blue brand, BOQ. We all know that our digital asset in BOQ is not where it needs to be, and over the next 12 months we will be working, part of that investment spend will be to bring the Blue brand digital assets up to an acceptable standard where it hasn't been in the past. Telephony and call centres are so important because customers, that's normally their first point of call. We have a wonderful team in our Customer Connect area up in the Gold Coast in Brisbane, and what we are going to be providing them with the latest in telephony and telephony technology to allow us to serve those customers' needs, whether it's a service requirement or whether it is an inquiry into a home loan or to help them through the home loan process. That's critical. And we'll be also rolling out our single view of customer as well, right across the group. That will have an added advantage in that it will assist brokers to be able to understand where they are in the queue with their broker applications. And I would argue that we have improved substantially our time to yes. I actually think some of the other competitors are going back the other way as they start to think about how they validate expenses. And there is any number of reports, newspaper articles, analyst reports on what others are doing to bring them up to the expected standard of validation of customer expenses across the industry. So I would expect that perhaps they may be going out further.
I'll handle the last part of your question, which was around the 925. Now, we talked about a 925 range in the context of a special dividend, i.e. handing capital back to shareholders. It was also the number we printed at the point APRA released unquestionably strong. I think on any measure we believe we're well capitalised and do have the flexibility to invest in the way that we've talked about. So, there's a number of moving parts. Touched on the St Andrews sale, more clarity from APRA around the regulatory guidelines, and I guess the last part, which we put the stake in the ground today, is around the forward outlook on investment.
So sorry, just to be clear on that, are you still sticking with the 9.25 interim target?
The 925 was a point in time, and there is still some uncertainty around how APRA will adapt the Basel IV rules and the localisation. So we want to see where that is. We believe that we're in a really strong position with our capital compared to peers, and we will manage our investments within the existing capital envelope that we have. So it is where it is, and we're happy with where we sit at the moment in terms of CET1.
So the fact that target is no longer there, can I take that to mean that that target was looking too conservative, and your capital position is looking very strong, and maybe 8.5 is the more likely target with the current risk weight setting?
Absolutely not. Okay, let me be really clear about that. We are not targeting 8.5. We've always been conservative on our capital settings. We'll continue to be conservative on our capital settings until we have the absolute clarity from the regulator on the localisation and adoption of Basel IV. It might be a few basis points here or there, but we are not going to 8.5.
Our next question from the lines, please.
The next question is from Ashley Dalziel from Goldman Sachs.
Morning, guys. I just had firstly a question on the NIM. I think at the previous result you said on the hedging cost piece, if prevailing spreads, cash bill spreads, were maintained, that would be a circa 5 to 7 basis point NIM headwind over the next two halves. And I guess you've sort of booked 2 bips in this half, but it sounds as though you've taken advantage of some hedging. Can you just kind of help us square, I guess, what you've seen in terms of headwind in the current half with that previous comment around a 5 to 7 basis point headwind over the next 2 periods?
I don't think those headwinds have changed much from the first half or the previous half, other than the front to back book pricing is very, very competitive out there at the moment, and we haven't seen a great deal of moderation at all in the cash to bills spread. So I think Matt's given a very clear view on the NIM walk, and the component parts of that NIM walk can change fairly quickly, and I think we've been very clear on all the moving parts for NIM.
And actually, just to add to that, I don't think any inconsistency with what we've previously said. We saw 2 basis points this half. Bills to cash has remained elevated. We've taken some opportunities to hedge where we can, but that looks like an ongoing headwind.
We'll take one last call from the phones.
The next question comes from Brett Lemmy-Sherry from Shaw and Partners.
Thanks very much. Slide 32 contains a lot of useful information on your housing portfolio. We've seen falling house prices, but the information that you've provided there looks like the people you lend to have increasing house prices. Another way of saying it is that the average house price was $550,000 second half 17, and you lent 69% LVR. Second half 18, it was 590,000, and you lent 69% LVR. What are you doing to find more valuable houses in a declining housing market?
So I think, thanks Brett for your question. There are a couple of moving parts on that. If you look at the growth in the BOQ specialist mortgage business, doctors and dentists tend to have a higher borrowing capacity. And if you go back to my previous comment, since 2014, that portfolio is over $4 billion. Virgin Money is actually brings us a different type of customer, particularly in the capital cities in Brisbane and Sydney. And again, that they would have a higher borrowing value. Prior to the results, I did go back and work with Peter Deans, our Chief Risk Officer, just to have a look at where we are in the cycle of repayments. And obviously, the older the vintage, the further our customers are ahead of their repayments. So, if you're going back 5 years, they're 6 months or even further ahead of their repayments. And even in the last 12 months, customers are some 1 month to 6 weeks ahead of their repayments. So I'm comfortable where we sit with our mortgage book, but those differences are primarily driven by the growth aspects of our business in capital cities and the lines of business that we're doing the mortgages in.
And just one further question, a simple one. When you show your portfolio metrics, you show the weighted average LVR. Is that on a dynamic basis, or is that based on the value of the house or value of the property at the time you put the loan on?
It's historical.
Okay, great. Thank you.
Okay, we can come back to the rooms. We've got time for 2 more questions. We've got a question here.
Good morning, it's Andres Sadnik from Morgan Stanley. Just wanted to ask a couple of questions. Firstly, on the deposit side, are you looking for more opportunities to change that deposit mix away from term deposits and towards transaction accounts? And my second question, looking at mortgage growth, but maybe from a touch different angle, you've grown about 2% annualized in the last half. System's grown about 5.5%. The non-banks have grown probably double of system. So, is there what can be a cue? So clearly the customers are moving away from the major banks, but for some reason they're going to BOQ, they're going, all the way to the non-banks. Is there an opportunity for BOQ to differentiate itself more from the majors and prevent, some of the, growth opportunities going to the non-banks?
So I'll deal with a couple of parts of that question. Just on... we've talked for a fair few halves now about what we're doing around managing our deposit spread, and we are deploying analytics capabilities. As I said before, we want to manage those maturity towers a lot better. But what is really important is what we are doing in actually getting the deposits in through the door into low-cost deposit accounts, and that is so important. That is the lifeblood of any financial institution. And it's a slow burn, it takes time, and we are on that journey and we are getting great momentum. One of the things that really gives me optimism about that slow burn journey is what we've actually done in the last 12 months. We've now got a partnership with Square. It's part of the Jack Dorsey empire, and Square is the fastest growing merchant facility in the US, and Square has chosen us to partner out here in Australia, and we do that quite proudly. It's a great piece of technology for SMEs. So if you think about being able to provide the Square device and actually have the bank account, that's really important. We've also been doing some work with First Data out of the US and in deploying their Clover systems. And again, we've done that in one of our high-profile clients in the snowfields, and that's similar to what some of the high-end products that you'd see at other institutions. And again, that is helping our business customers to manage their cash flow on a daily basis. So it's not just about trying to slice a few basis points here and there off the TD book, but it's also the long burn strategy that we actually have around garnering deposits for retail customers and for business customers using some of the best technology in breed in partnership. The question you've asked about non-bank lending is, that's a big question. There is a lot of pent-up demand heading towards non-bank lenders. They have a role to play in the financial community. The last thing you want to see is wholesale large parts of the community unbanked. But are they subject to the same scrutiny and regulation and responsible lending, even though they do hold an AFSL credit licence, is an open question. And We do see that over time, through our growth initiatives with Virgin, BOQ Specialist, and a focus within the BOQ network, that we will continue to grow our mortgage business. It is important to us. Whether we'll grow at multiples of system in the current environment, it's probably a period away. But I'm very, very comfortable about the growth options that we actually have across the group.
And one final question, just over here, Ed.
Thank you. It's Ed Henning from CLSA. Two questions from me. Firstly, just touching again on the funding costs you kind of just ran through, and you talk about a little bit about the sophistication in your TD book and what's happening there. Can you see any? You've obviously done a bit in this period. Is there any more tailwinds for you going further on that? Besides the current account stuff that you're obviously continuing to work on.
Look, we've been very open about what we believe that NIM walk is and the NIM outlook and what the component parts are. And as we've seen in the past, it's a competitive environment. Things can change quite rapidly. And what I take comfort of is that we've got the ability to take advantage of any of those changes that we may see in the marketplace that will aid us in managing our NIM. It's a much more dynamic approach that we're using in managing both sides of the balance sheet for NIM and NIM outcomes.
And then the second one, just on costs, and you touched on it briefly before. You've talked about your investment in cloud, investment in digital, and you've talked about the acceleration of amortisation going forward. Can you talk about the cost savings and stuff from going to cloud, from going to digital, that you'll see offsetting that increased amortisation at least in the next couple of years?
Yeah, so I think we've been very open about where our cost growth has been, and we believe it will continue on that trajectory while we also continue to invest in our business. Let me talk a little bit about the cloud. We're going to a hybrid cloud. That's a huge change for us. Our infrastructure doesn't allow us to be very flexible at the moment, and moving to a hybrid cloud will actually increase our flexibility. So at the moment, our production and test environments are commingled. That's not where we want to be. So when we do want to develop really fast products and get them out to market and meet customer needs, moving to a hybrid cloud is going to be fantastic for us because it'll allow us to unpackage that commingled environment and set up discrete test environments, which will actually lower the cost of product development. There will be some one-time savings in moving to the cloud. It's not significant, but the piece where we get the most juice from is actually having a faster and more responsive IT infrastructure to allow us around our product development.
We do have time for one more, Richard.
Good morning, Richard Wiles from Morgan Stanley. John, you mentioned a few attractive features of the result this morning. So more diversified, margins are up, loan losses are 9 basis points, and I think your underlying cost growth was 1% for the year. So a lot of things going right for the bank, even though it's a challenging environment. And yet on slide 4, we can see that the ROE's gone below 10%. That's the lowest it's been in 5 years. That just leads me to ask a few questions. Firstly, do you think it can go back above 10%? Secondly, what's the ROE of BOQ business? Because that's the bit of the group that's growing fastest. And thirdly, are you prepared in the short term to actually give up a little bit of ROE to accelerate some of the growth initiatives that you've mentioned this morning?
Yes, certainly. The ROE line has been challenged through non-interest income, certainly. In the BOQ group, we're very attuned to the return that we need to generate, and some of the lending that we would do would be probably less than what we would like in terms of a hurdle rate. But we are prepared to do that because what we are trying to leverage is that total relationship model. And when we do that, the ROE for those customers is quite strong. So I am hopeful that we can restore the ROE, and we will do that over time through the investment that we've outlined today. But importantly, if you think about FM Digital that we'll be bringing online next year, it gives us the ability to be able to talk to our customers, and they'll be able to deal digitally with us for their foreign exchange, for their interest rate hedging, And again, that will help restore some of that non-interest income that we actually have. It is a challenging environment at the moment. I would still argue for competitive neutrality. I would still argue that standardised banks' capital allocation on mortgages is materially higher than what a advanced accredited bank is, and we should see further narrowing of that. And we would be hopeful in that regard.
Thank you. That brings an end to the briefing. So thank you for joining us.
Thanks, everybody.